Hi, Steve and Sally Smith. I'm here to present your estate plan. So here's a PowerPoint to follow along. If you have any questions, just let me know at the end. Now, what I currently know of you is that with your beneficiaries, you designated your life insurance policies for each of you to be the primary beneficiary. So Steve, you made Sally your primary, and Sally, you made Steve your primary beneficiary. If that is different, please let me know. I also have you jointly owning your home with no split percentages as far as contributions. Like Steve, you didn't contribute 80% and Sally just 20%. With you both being married, just joint tenants with rights of survivorship, and it being equally owned is what I have. If it's different, let me know. I also have you both owning the balanced mutual fund account. And in the future, I note that there's possibilities of these items you would own jointly. I wanted to make sure I listed them. Any personal property or a checking account you could have owned jointly, or commercial property you would own jointly, along with a vacation home. Now, I also see that Steve, you own your own insurance policy, and Sally, you own your own insurance policy. If there's anything different, let me know on that. Also, I see that there are some documents that are needing to be prepared. We've discussed this or asked you questions as far as a will or healthcare power of attorney, if you had any of these, along with a power of attorney or a living will. If any of these have been updated, let me know. But these are very important documents as far as planning for your estate or how you'd like to transfer things. And also with the power of attorney document, it instructs who you trust and want to be acting basically as you in certain situations. Um, the attorney should be the one to prepare such legal documents, so that is who you would need to go see to get these documents written. And they will ask you further questions on what you would prefer, of how you like things transferred, or who you would like to appoint as your power of attorney. Now, this may seem like a lot of information, but I want to reassure you that this is a rundown or how I have calculated the gift tax, and based on the annual exclusion as well, that you would give your children in the year 2045. Let's say, Steve, you pass away in 2045. That's 25 years from now. The current gifts that I would see would be $7,860,000. And I give you a rundown of what those are. You are wanting to split the Lego store between Sarah, Steve Jr., and Sam. Sarah and Steve receiving 30% and Sam receiving 40%. And then Sam, you wanted to pass along the automobile of $40,000 or $70,000, excuse me. So to calculate an equal amount of inheritance to what is given to Sam, you can see that calculation there for each child to receive $2,590,000. Then you are wanting to give your grandchildren $15,000 each, and you have 6 grandchildren, therefore it would be $90,000. I then subtracted the annual exclusion, which means each year you're able to give to one individual person $15,000. You then had 9 people from the above, and giving $15,000 to each, you accumulated an annual exclusion of $135,000. We subtract that from the total current gifts, then you get the total current year taxable gifts. So we then look at and say, okay, any prior years did you gift to anybody with that annual exclusion, or anything that would contribute to your amount, allowable gifting amount? I didn't have any records, so I put a 0. Therefore, the total taxable gift amount would be $7,725,000. To calculate the tax on that, we took that amount, subtracted $345,800, and then multiplied the remainder of that by 40%. We got $2,951,680. Any tax on prior gifts? Well, then we didn't have any prior years of gifting, so we have a 0 there. Therefore, we carry the balance down. And from there, we have the applicable credit So in your lifetime, there is the applicable credit of $4,577,800. You didn't use any of that prior years, therefore we still have that remaining balance. And the smaller of that amount, we have $2,591,680. So the total gift tax for that $7,860,000 is $0. That's what the calculation is stating here. Now, let's say we're going to calculate the probate estate if you would pass away on July 1st of 2045. So we take the assets that you had, looking at that, if it is a jointly held asset, it does not go to your probate estate. Half of it goes to your gross estate, but we will cover that in the next slide. So it doesn't pass through probate since it's going directly to your wife, Sally. So that's where you will see zeros. If it is just you owning the asset and there is no clear beneficiary of the asset, then it will go through your probate estate based on the will that you would have created. So hence you will see the Lego Creations business going through, the Cornelius stock going through the probate, along with your 403B. I tried to line them up as much as possible, but it was a little difficult. But hopefully you can follow along here. I also see that the automobile, since you're giving it to Sam, would be going through a probate estate. Therefore, if you add all of this up, you'll get a probate estate of $27,320. Seems like quite a bit. So let's go a little further and go to your gross estate. To the estate tax that you'd have to pay based on what goes through your gross estate, we first have to calculate your gross estate, which you will see here. If it's a joint account or jointly held, again, 50% of that would go through your gross estate, 50% will go through Sally's, and your Lego business goes through all the way. Cornelius stock is all of it goes through. Your balanced mutual fund, half of it goes through. Commercial property, half of it. Your 403B goes through all the way. Now, since Sally, your assets are in your name only with a 403B, then it does not go through Steve's estate. So that's where a zero comes in play. Then your residence would be half, vacation home half. Your automobile is all of it. Sally's automobile is zero, and their personal property is half. Therefore, the total calculation is $32,820,000. So from there, we have to calculate the assets qualified for the marital deduction. There is an unlimited marital deduction if, Sally, you are a U.S. citizen, which I assume you are. And so we take the gross estate and we subtract what you are wanting to give Steve through your will or pass along. So therefore, you wanted to pass along the Lego store to your 3 children. You wanted to pass the car to, or transfer the car to Sam. You wanted to give an equivalent amount of cash to each child. So that's where that amount adds up to. You also wanted to give to your grandchildren. So with all of that subtracted from your gross estate, $24,960,000 qualify for the marital deduction. From there, we can then calculate the estate tax. As you can see, we take that amount of your gross estate. We then go down to your subtracting the last medical and funeral expenses from the estate paying the administrative costs and any debts. So the adjusted gross estate would be $31,755,000. Then you'd subtract any charity deduction you'd make, any marital deduction, which we just previously calculated, and the taxable estate would be $6,795,000. From there weren't any previous taxable gifts, so it's zero. Tentative tax basis would be carried down, and then we calculate the tentative tax like we did previously. And then from there we subtract any credits. So as you can see, here's the list of credits. We again, the applicable estate tax credit, we hadn't used any of that, so we now apply it here. So you would have a negative amount of the total tax credit, meaning you still had a little bit more to utilize. Therefore, there would be no federal estate tax liability. So if you don't die in July of 2045, there are some other options in which you'd be able to pass along or transfer the Lego store. For example, you could put it into a trust. So the business funds the trust and the trustee would direct the appropriate portions to your children. Or you could create a buy-sell agreement between the children to the estate. So the estate would sell the business interest to those in the agreement, and it could go to one or more of the individuals or your children. And they could also use a life insurance to fund the purchase. Now, this would avoid probate, so it would decrease your probate estate by that $6,300,000. There's other options as well to be able to help you either bypass probate or kind of decrease some of the gross estate as well. So if you have a bypass trust, you could use the applicable gift tax credit, which is $11,580,000, and you would put an asset in here you think would appreciate considerably. So as we see in the future, let's say it would be the Cornelius stock. It appreciated to $18,500,000. This would avoid the transfer tax, and it would allow income to go to Sally as well. There's also the tangible personal property trust that allows you to put any artwork or antiques in there, but the IRS might frown upon that because the value might be hard to transfer to various individuals. The Q-tip trust, which you could create either when you pass away, Steve, or while you're living, it can be created. It allows the surviving spouse the right to the income of the trust during the remainder of her life. So Sally, you'd receive the income from the trust, and then the assets would go to the beneficiaries. This could help utilize the unlimited marital deduction. So as I looked over all that you had in calculation, it looked like a lot went through probate and a lot was included in the gross estate. So just trying to help you decrease the amount of probate, because that means you would have to be paying more expenses, administrative expenses too. And it might take a very long time. So if you want the beneficiaries to get the assets right away or in a less amount of time, this would probably be the best option, is to decrease that amount of probate estate. Also, utilizing the marital deduction, it is unlimited. So you could transfer quite a bit to Sally or Sally to Steve. Let's go on here. So I had some more questions then. In your will, you stated you wanted the assets to go to Sally, but I didn't see anything about if you both pass away, what would you want to have done? I also was wondering, you can designate beneficiaries for your 403Bs and not have it go through probate. So for both you, Steve and Sally, you can have that done. You just have to tell me, or whoever owns the 403B, put the beneficiaries on there. Also, you could put beneficiaries on the Cornelius insurance or incorporated stock, and that would not go through probate. Also, I'm wondering what you guys were thinking of doing if Sally, if you predeceased Steve, what would that look like? Also, I was wondering who you would want your beneficiaries to be for the balanced mutual fund, if Sally would pass away or both would pass away at the same time. Also, who would you want to get the house or vacation home? We didn't really cover too much of that. So I still would like to see the documents of your will, your power of attorney, your healthcare power of attorney, and if you are wanting to put any beneficiaries onto those things listed above, then we'll need documentation of that as well. And we'll also need a living will. So if you have any other questions, please let me know. Thank you.